When payments are overdue by 30 days or more, an account gets slapped with the dreaded delinquent label. With interest rates staying sky high for a while, it's time to dive into the latest delinquency trends sweeping across the United States. Hey there, I'm Jun, a researcher from Dxpert. Consumers' economic data took a nosedive in the first 4 months of the year, with sentiment and delinquencies leading the change. Near record high credit card balances, rising delinquencies, and dwindling savings are spelling trouble for consumers. But here's the twist: it's actually good news for inflation. As inflation tightens its grip on consumer budgets, Americans are swiping their credit cards like there's no tomorrow. But this spending spree can last forever. In the first quarter, total credit card balances soared by about 13% to a staggering $1.15 trillion, a slight breather from the 14.5% jump in the previous quarter. Meanwhile, the percentage of US credit card accounts that are 90 days or more delinquent shot up by 29%, more than doubling since the first quarter of 2022. It's now 160 basis points above pre-pandemic levels and the 15-year average. The delinquency rate hit 6.86% in the first quarter, compared to 5.3% in late 2019, and the long-term average. Since the end of 2021, the percentage of US auto loans that are 90-day or more days delinquent has skyrocketed too, surpassing both pre-pandemic levels and the 15-year average. In the first quarter, delinquencies shot up by 17% to 2.78%, compared to 2.36% in the last quarter of 2019 and the 15-year average of 2.15%. And note this, in the last quarter, a record 17.9% of new car buyers were shelling out more than $1,000 a month for their vehicles, with the annual percentage rate hitting a whopping 7.4%, which is the highest since the end of 2007. In the mortgage segment, delinquencies have surged dramatically since 2021. In the latter half of the year, delinquencies were just 0.27%. Today, they have skyrocketed to 0.91%. That's a staggering threefold increase. This alarming trend casts a shadow over the housing market as more homeowners struggle to keep up with their payments. Nonetheless, this spike in delinquencies aligns with the outlook of the Fed's Vice Chair Philip Jefferson, who suggested that higher interest rates are making the mark on the US economy, where high prices are proving stubbornly persistent. As mortgage delinquencies climb and housing prices remains high, let's dive into the latest consumer sentiment and see what it reveals about the current state of the housing market. In April, seasonally adjusted US home sales took a dive as 30-year fixed mortgage rates climbed back above 7%. Buyers' confidence has plummeted to an all-time low, even worse than during the 1980s. Of course, driven by declining affordability. Potential home buyers are calling this the worst time to buy a home in the history of the University of Michigan Consumer Sentiment Survey, a period that includes even the early 1980s, when mortgage rates soared above 18%. Even new home sales couldn't escape the impact of higher mortgage rates, marking their first annual decline in over a year in April. Meanwhile, existing home sales have been on a year-over-year decline for a staggering 33 months straight. The housing market is clearly feeling the strain as affordability issues and rising rates take their toll. However, despite all these factors and an increase in homes available for sales, house prices continue to defy gravity. While skyrocketing delinquencies might make it seem like the economy is in a free fall, a long-term perspective offers a different story. The total debt balance is still below the pre-COVID levels. This trend appears to be more of a normalization rather than an impending storm, which is great because it means the economy is slowing down. It's a necessary adjustment to stabilize prices. For now, this cooling off period is a positive step towards taming inflation. However, if this trend persists for too long, it could indeed signal future concerns. It's a delicate balancing act right now. It's less of an economic crash and more of a recalibration. So, keeping an eye on this patterns is crucial as we navigate through this economic landscape. Thanks for joining me today. I hope you have gained insights from today's video. Everything I have shared are information that I've picked up and learned, sprinkled with a bit of my own takes on things. When it comes to trading or investing, do your own due diligence and be mindful of the risks. If you find this video helpful for your research, please subscribe, share, and like it. Quickly access to all our channels by scanning the QR code. Take care, and I'll see you in the next episode.